Let's talk about mortgage products. To do well on the NMLS exam, you have to be familiar with various mortgage products, and that's what we'll be discussing today. Let's begin with discussion of closed-end mortgages. Closed-end mortgages have a predetermined final payoff date. That means there's an established time at which the debt is repaid. And examples of closed-end mortgages include fixed-rate mortgages, adjustable-rate mortgages, balloon mortgages, and graduated payment mortgages, or GPMs. Let's discuss fixed rate mortgages. In fixed rate mortgages, the interest rate remains constant. In fact, the principal and the interest both remain constant. And an example of a fixed rate mortgage is a traditional mortgage. And what a traditional mortgage is a 30-year fixed rate mortgage. Let's discuss adjustable rate mortgages, or ARMs. In adjustable rate mortgages, the interest rate can change over the term of the loan. Specifically, the interest rate changes based on the financial marketplace, and it typically starts with a lower interest rate than a fixed rate mortgage. Types of adjustable rate mortgages include traditional ARMs, hybrid ARMs, and option ARMs. Let's talk about traditional ARMs. Traditional ARMs have a rate that adjusts on a periodic basis, and most of the time the interest rate adjusts annually. A hybrid ARM is the most common type of adjustable rate mortgage. It has features of both fixed rate mortgage and an adjustable rate mortgage. And an example of a hybrid ARM is a 5-1 ARM. In a 5-1 ARM, the interest rate remains the same during the first 5 years, and then after the fifth year, the rate will adjust annually. Let's discuss option ARMs. In option ARMs, the borrower has the option to make three different payment amounts. For instance, the borrower can make fully amortized payments, they can make interest-only payments, or they can make minimum payments which would lead to negative amortization. So we said that adjustable rate mortgages have interest rate that fluctuates based on the financial marketplace. To understand this, you have to understand what the margin and the index is. So an ARM interest rate is determined by the margin and the index. The margin is the lender's profit on the loan. The index changes based on the financial marketplace. So it is the index that changes based on the financial marketplace and changes the interest rate in an ARM. What you have to understand here is this equation, and this equation is the fully indexed rate equation. What the fully indexed rate is basically the margin plus the index. So fully indexed rate equals margin plus index. And common indices include United States Treasury bill or T-bill, the cost of funds index or SOFI, and the secured overnight financing rate or SOFR. Let's talk about caps. Most ARMs come with caps, and caps are set limits which the ARM cannot exceed. There are three types of caps: the initial cap, the periodic cap, and the lifetime cap. The initial cap is defined as the maximum amount that the interest rate on an adjustable rate mortgage can adjust at the first scheduled rate adjustment. So this is all about the first scheduled rate adjustment. What the initial cap does is it sets limits on how much the ARM can change or can or cannot exceed on the first scheduled rate adjustment. Now, the periodic cap is different. The periodic cap is the max percentage that the mortgage can go up during subsequent adjustment periods. This is a limit to how much the interest rate can change on all subsequent adjustment periods other than the initial adjustment period. Remember that the initial cap is the max percentage that the interest rate can go up or down during the initial adjustment period only. The periodic cap is different. It has to do with all subsequent adjustment periods. Now, the lifetime cap sets limits on how much the interest rate can change over the entire life of the loan. So for the lifetime cap, you have to remember that this has to do with the limits over the entire life of the loan. Let's talk about graduated payment mortgages, or GPMs. In graduated payment mortgages, there's monthly payment amounts that increase annually until they reach the full payment amount. The payment typically grows between 7 to 12% annually, and it allows homeowners to start with lower monthly mortgage payments. Balloon mortgages have low monthly payments with an eventual lump sum payment before the end of a 30-year amortization schedule. An example is a 30-15 balloon mortgage. In a 30-15 balloon mortgage, the borrower makes monthly payments for the first 15 years. After the 15 years are over, the remaining balance, which is a lump sum, is due. So what we've discussed so far are closed-end mortgages. Now we want to move our discussion to open-end mortgages. In open-end mortgages, there is no established time at which the debt must be repaid. And there are two types of open-end mortgages that you need to be familiar with. The first is a HELOC. A HELOC stands for Home Equity Line of Credit. The second type of open-end mortgages is reverse mortgages, which is for older borrowers, specifically 62 years of age or older. A HELOC provides a revolving credit line, which is borrowed against the equity of the home. The house is used as a collateral for the line of credit, and it functions similarly as a credit card. There's two types of periods in a HELOC. There's the draw period, which is the period in which the homeowner can draw money from the line of credit, and it usually lasts 10 years. And there is a repayment period when the debt must be repaid, which usually lasts 20 years long. Now let's discuss reverse mortgages. Reverse mortgages are geared towards homeowners that are 62 years of age or older. A reverse mortgage involves borrowing money against the home's equity, and lenders make payment to the homeowner. This is quite different than most mortgages. With most mortgages, it is the borrower that pays money to the lender. Here, with a reverse mortgage, it is the lender that makes payments to the homeowner. Now, keep in mind that this is not free money. This is a debt that must be repaid. There are requirements for reverse mortgages. The borrower must be at least 62 years of age, the home must be the primary residence of the borrower, and there must be no liens on the property in which the reverse mortgage is placed. The borrower must also comply with the following additional requirements. The borrower cannot declare bankruptcy, the borrower cannot rent out the property, the borrower cannot add additional owners to the title, and the borrower must keep and maintain the property in good condition. The borrower must also pay taxes and insurance on time.